IULs. So we got about 30 minutes, 29 minutes. I'm going to go over real quickly what one is and the purpose of an IUL, just to give people a little idea. Now, I personally did not write one IUL my first year going Hall of Fame. It wasn't because I didn't want to. I was just keeping it simple. I didn't even know how, even if I wanted to write an IUL. So there are a couple of companies. Well, first, what is an IUL? It's an indexed universal life policy. There's different kind of policies. There's universal life. In life insurance, there's term life, whole life, and universal life. I think of universal life as term and whole life had a baby, right? And that's what a universal life is. Universal life, just think of it this way, you can lose money if you put your money in there, meaning you can end up paying more monthly for the policy than you initially started. But typically with an index universal life, when it says index, you really never lose money. And that policy is fixed. As long as it was designed properly, you will not pay more ever than that policy is set in the beginning. The reason people get IULs, well, it's for tax growth, it's for retirement. There are multiple reasons. Just remember, when it comes to life insurance, the first thing to knock out, the first hurdle is income replacement. So you want to replace someone's income. That's step one. Once that's done, then step two is to maybe look for other sources, other ways where you can kind of build wealth at the same time. So think of it like a house. I always go into a family, I say, listen, we're going to build this like a house. They may say, hey, I want an IUL. But when you do the financial inventory, you find out whether or not they're able to even afford one. For an IUL to work, the purpose of it is to overfund the policy. I've gone in homes where they want an IUL, but the truth is they don't understand it. It's almost as if everyone wants a Mercedes, but they're not willing to pay premium gas prices. Yes, they'll get the Mercedes, but then they're, oh man, it's $2 a gallon. You can't get both, right? So you need to basically help people see where they fit. So let me kind of give you an understanding for an IUL. For an IUL, if someone wants to pay a small amount of monthly payment to make an IUL work, it's not the best fit for them. An IUL is not for everyone. First, for an IUL to work, they first have to be, qualified on the medical side, because that's term underwriting. And that means, any heart issues, it's usually no. Any internal cancer, usually no, right? You have to have almost pristine health. They do take high blood pressure depending on situations, but it isn't just for any random person. Of course, the money-wise, they have to qualify. And then the third is the reason that they're doing it. So here's what I mean by that. For an IUL to work, you have to be able to overfund the policy. Here's what I mean by that. So let's say I'm 30, 40 years old, and I want a $200,000 death benefit. The cost of insurance for me, just for easy math, let's say it's $50, right, for that policy, okay? And I want to do an IUL, I'm paying, let's say, $100. So let's say $50 of that $100 is for my cost of insurance. The remaining 50 gets invested into the market. The market goes up, it increases your your cash value. And with that cash value increase, so you literally are growing cash with your policy, right? The beautiful thing about that is, well, people are looking for ways to be able to grow their money. Well, what is the safest way to do it? Well, do it the way the banks do it. The banks do not invest in things they will lose money on. The banks are very, very, very specific. Hence, some of you have applied for loans. Some of them, they've said no, right? You know yourself, but they don't know you. You are too risky. So how can people grow their money? Well, an IUL is a great opportunity. Why? Well, if the market goes up, it takes some of the gains. The market goes down, it backs off, it waits for it to come back up, and then it returns and it gets some of the gains. It doesn't get all the gains, it gets some. That's why it says indexed, right? Index means, again, you can't lose money. So $50 of that 100 is going to the market to grow. And the hope is, as time goes on, the cash value grows enough fast that it will supersede that $200,000 death benefit. So my hope is I get it early enough where 20 years, 25, 30 years from now, instead of having a $200,000 death benefit, I have a $250, $3 million. I mean, talking not only death benefit, but that cash value, that's cash that I can pull from when I need to. That's the goal. Well, what determines whether or not it's going to grow? Well, it's how much you put into it. So prime example, imagine the amount of monthly premium that you're putting into an IUL is how imagine a car that stands still and you need to push it. How much you're pushing it is the momentum you're giving it. What is the pushing? It's the monthly premium. So my point in saying that is if someone, if again, cost of insurance is $50 and they can only afford $60, IUL is not for them. It's not for them. They should just get life insurance until they get in a position where they can actually afford an IUL, right? It sounds great, but it's not the best because the policy will not grow fast enough for it to really do its job. They would be better off just putting that money into buying more life insurance, right? My recommendation, again, this is just me. If a person's not willing or able to put $200 to $500 a month in an IUL, it looks nice, but it's really not. It's like those people who have those C-Class Mercedes. I'm not knocking you. The C-Class Mercedes, they call it the poor man's Mercedes, right? Because it's basically a Honda or a normal car just with a Mercedes symbol on there. That's it. It doesn't have all the fixings that a luxury vehicle normally has. My recommendation would be just, depending on the situation, get normal life insurance. All right, so we got why an IUL is there. So the goal is, in that same example, if the cost of insurance is $50, you want to be able to put in $100, $200, $300, $500, because the cost of insurance is the same. You're investing the difference in the market. Now the markets are growing. It's the same car, but it's going even faster. It's almost as if you got a back door. And I love the IULs because of course, you get the tax benefits, you get living benefits, all those other bennies of normal living benefit life insurance, but with a investment arm, if you will. Okay, so that's IUL. Anyone have any questions? Throw it down in the chat. I can knock it out. Now, there are multiple companies that we use for IULs. I'm going to give you my opinion. This is just my opinion. The baby IUL is Mutual of Omaha. It's simple, easy. We use that for a couple of reasons. If someone's healthy, I don't actually give an IUL-E is what the product is called with Mutual of Omaha, Index Universal Life Express. I don't give them that product if they're maybe 60 years old because they're looking at maybe retirement. I just do it because it's the cheapest form of insurance that will give them the biggest bang for their buck, right? So if someone's saying, hey, they're looking for final expense, you actually could use the IUL-E for final expense because pound for pound, they get more death benefit, more benefits, all the fixings for the price than they're paying for a traditional whole final expense product. So if they're qualifying, if they're within the age of, I would say between 55 and 70, IUL is a great option if they're just looking for final expenses. But again, they got to qualify, okay? The reason final expense products are the ideal for most clients in that range is because of health. They can't, because it's term underwriting. Remember that, it's term underwriting. So if they can't qualify for an IUL, then you have to go the traditional final expense route, which is really how it works, right? All right, so that's the IUL in general. Again, any question, throw it in the chat. There's two companies. So Mutual of Omaha is the baby IUL. It's easy solve. You literally just put the button in, how much coverage they want, and hit calculate. It gives you how much they need to pay. And as long as they pay that monthly premium, it will never go up. It's illustrated so well, meaning it's already designed that as long as they pay that every month, it's just going to grow. It's the best product. I mean, if someone can qualify for that, they get living benefits. I'm talking all three. Chronic, if chronic, critical, and terminal, chronic illness, if they got disabled, where they couldn't perform any 2 of the 6 living functions, they would have the ability to actually pull from that policy cash from the death benefit, not from the cash value, the death benefit, right? Whether that be 50 grand all the way up to $300,000. By the way, Mutual of Omaha only goes up to 300,000 for their IULEs. Chronic, I just did chronic. Critical illness, they got heart attack, stroke, cancer, organ failure, anything like that. And then there's a list. They can also access the death benefit of that policy while they're alive. Terminal illness, you guys know what that is. If they have 12 months to live, they can access that policy while they're alive, right? That's awesome. Whereas, again, most final expense products, it's just terminal illness. Great product if someone's simply looking for that. Again, bigger bang for their buck. That's why I write it, right? Again, going back to IULs. So if someone is young and they can't put very much money in, but they want to have a Mercedes, I go Moon. Now, if they're serious about actually doing a real deal IUL, I'm talking S-Class, they want a real IUL. 2 companies that we use, F&G and NLG. F&G, you have to actually have an app ready to contract. And I think the first one, that might be a paper app, if I remember correctly. I'll have some correct me, but I believe so. NLG, I think they are starting to do e-contracts where they're sending it out to you, when you say you want it. But here's the truth with the difference. You can choose who you want, but my experience has been F&G, they outperform, again, as of, March of 2023, they outperform pound for pound NLG as far as cash growth. Now, NLG is known for living benefits. Like, they give more percentage advance on living benefits than anyone else. Now, F&G is still great too. I mean, it's like 95% of living benefit they advance, so it's still pretty good. But NLG is known for the biggest, baddest living benefit there is as well. So I'm going to show you how to illustrate an IUL using F&G, okay? Let me go ahead and share my screen, and if anyone can please go on the chat and tell me if you see my screen. All right, let me know if you see my screen. I can't even see it. Let me see. All right, Jose, thank you, sir. I see you. Hey, if the chat is available, please comment on the chat. It's easier for me to see. All right, perfect. You can see my screen. Perfect. All right. So this is F&G. I'm going to start from the beginning just to make sure that everyone understands the situation. So, all right, so you click on this, you log in, financial professional. Thank goodness this is already logged in. They have a weird number. They have two numbers you'll get. One is for annuities because they do annuities too. One is for annuities. The other one is for logging in. It's a little tricky, so I'm just showing you so that you don't have to worry about calling in to do it yourself. You go in, sales, tools, illustrations. Look on this website right here. And it pops up, and they use iGo eApp. It's similar to all the ones you used to with Mutual of Omaha. You're actually going to start new case, right? So I'm going to do just a random one. And if someone could go ahead and just pop in your date of birth. Let's say someone, I'll just put a random one. I'll put Joe New Haven is his name. 1/1/1994. He's 29 years old. Remember, men, of course, are always more expensive than women. You choose the state. Let's say he's in Arizona, and you're going to choose Index Universal Life, find products, and the one you want is the Pathsetter. There's other ones, but don't worry about it right now. Just Pathsetter. Remember that. You select it, and this is where it gets good, and that you'll have to pay attention. And again, as far as this part, you're wondering to yourself, well, when would I use this? Well, if you need help, if you have someone that wants an IUL, you can do one of two things. You can get some help to run the illustration, or you can just do one real quick. It's not very difficult. You literally can log in and do it. But again, the goal of the IUL is it's not so much someone needs to see all the numbers per se. They just roll with it. So anyway, you put that in there, non-tobacco, you're going to solve for max accumulation and income. Okay, just remember that. There's multiple things you can do with an IUL, but that's what you'll be solving for. Face amount, and this is where you want to do age. A is an apple, 65. That's the age, because at 65 is when most people are retiring, right? That's the age we're looking at. And also, you're going to scroll down, use this, use 7702, just click it. All that means is you're going to do a minimum death benefit, maximum growth. If someone comes to you and they say they want an IUL that's $1 million worth, they don't get it. You don't get an IUL because you want a big death benefit. Think about it. That same example I gave you about the $50 of cost of insurance. The goal of an IUL is to overfund it. Use all of its resources towards the growth factor to get more cash and be a tax shelter. Why would you eat up that $100 with more of a death benefit? You wouldn't. So you don't want a big death benefit. You want it to be the least amount of death benefit as possible so that all that money goes towards growth. If someone's asking for the opposite, your job is to educate them. And what we always suggest is what I always suggest. Okay, let's get you a small life insurance policy. You can do just a small basic life insurance policy, no frills. And then we'll put the rest of the money towards the IUL. You do two separate products for that reason versus having one that's big, because it makes no sense in that regard. So you click a specified face amount, and then this is where you're going to put the monthly premium. If someone pays annually, it grows faster than if they pay monthly, because think about it. If they pay annually, the money's there one-time lump sum to start investing all that, right? What's going to make more money? $100 or $1,000? obviously. So make sure you change them monthly because that's what most people do. And you're going to go ahead and put, I don't know, let's say it's legit. Let's say it's $400 a month. I'll just make it even more simple. Let's say it's $200 a month. 200 a month. Check, boom. Now, let's say someone said, hey, I want to start with a lump sum of, $1,000. So what you would do would be you literally would go to the first year and you would put 1,200 because, of course, plus the $200. And that would illustrate that they were putting in $1,000 up front, right? But let's just say it was easy, $200. And it's this simple, guys. You hit OK. It does this thing, nothing else. You hit OK. And all you do is hit two things. You can either do a quick calculation where it'll show you real quickly. Let me see if it'll show this. I don't think it may not show this since this may be a different screen. Let's see. Yeah, I won't show it, I don't think. All right, it's coming up. All right, let me know if you see this quick calculation or if is it a different screen. All right, maybe not. All right, if you don't see it, that's okay. I'll just share it again. You normally will click, I click view illustration. So this will pop up the illustration. Oh, thank you. Pop up the illustration where the client can actually see what's going on. Let me see. Nope, not that one. All right, it's not popping up here. I'm waiting for it, All right, it's still popping up. Look at that. So it's loading. So here's what I do. The reason I'm a little late, I was just helping KT. He's gonna be a new agent. He's getting one for $500 a month. And so I give three options. The kicker for the IUL to work is no different than life insurance. Let's make sure you can sustain it. I mean, it makes no sense having this big dream, hoping, let's get you something that we know come hell or high water, you can sustain. So I give three options. So the first thing that I do, I'm hoping you guys can see this one. Let me share it again if you can't. I'm gonna hit share. There we go. So it'll pop up this. Page 8 is where it shows the illustration. So 3 columns. So you see Joe Newhaven, you see his situation. This is the face amount that the system automatically generates based on you indicating lowest death benefit, maximum value. If you put that Joe Newhaven was wanting to pay $2,000 a month, it would generate the needed face amount to make sure, oh, I messed up one other thing. Oops, I messed up one other thing. Let me show this to you. You also want to do option B to A. Whoops. And you want to put A65. I messed that up as well. All right, let me fix that real quick. And that is it going from, actually, you know what? I'm not even gonna comment on that. Just trust me for now. That's what you want to do. Let's talk offline on why. So let me stop it and I'll reshare. All right, so it matches the death benefit according to how much is being paid monthly. So the reason that is the case is because this is a backdoor. Again, it's a tax shelter because you cannot be taxed on loans. So it's almost as if the reason it has to be this way is they put, if you're paying, $1,000 a month, they have to put a death benefit that's far enough where the government, they're not stupid, right? They know this exists. It's almost as if you're buying back, paying up the loan, if you will, right? So because of that reason, it makes it, possible. So you'll see it, variances of that amount. So page 8, and I'll just show you this, and then I'll just throw it open for questions. I see there's a question over 100 after the premium or premium included. Sorry, if you can ask your question again on the chat, Jose, not on the QA, on the chat, because the chat should be open, and that'll help out. All right, so page 8, where are we at? Okay, so page 8, 3 different columns. This is if, all hell broke loose. We had 9/11 for like 10 years in a row. Like, I mean, it was bad. I'm talking World War III. Everyone was losing their shorts. I'm talking, again, 9/11. Remember how things went backwards? This is what you would at least get. So the way I always think of it for people where they're like, well, what if market gets bad? Well, if the market's bad, you would be losing worse if you didn't have this, because again, Index Universal Life, you were guaranteed to not lose money, right? So this is what you would get. We never focus on this column because it doesn't happen that way. Again, this is like 10 years in a row. Column 2, again, this is where things would be okay. Things were down for a little bit, depressed. You're looking at about 4.5% growth. Here is where you always focus on. because this is the current values. This is what it is. They look back about 20 years. Had you had your money invested, or had you been putting that amount of money in this kind of program, this is what it would have been. So this is like the reality, but by law, they're required to show you the other two. So when you're looking at it, they're just again required. This is what you focus on. So monthly premium here, this is the account value, meaning cash flow. This is what you could pull from. So the more money you put in, the more you have access to. So if you do the math, you figure you put in what, 2,400. So we divide your cash available at year one, 1974 divided by 2,400. That's 82% of the cash you put in, you have available to you. That's not bad. So if you needed to go borrow from it, the beautiful thing about IULs, you would, let's say you wanted to borrow 1,000, you could. Now you wouldn't be borrowing from your personal policy, you'd be borrowing from the general account of the life insurance policy. Obviously, you can't exceed the amount of money that's available in cash to borrow, but you could. Now you're going to be paying a small loan. It's a percentage to the insurance company. That's how they make money. Now, here's what's cool about that though. Some people say, well, I'm paying money to take my own money out. Well, that's not the point. The reason that IULs are so popular and they make sense is not that immediate. It's the long-term cash compounding interest over time. Compounding interest is, you invest your money, you make interest, but you're making interest on interest. So here's what I mean by that. As time goes on, so you borrow the money, your money keeps growing as if you never borrowed from it. So normally if you took out $1,000 and you had 1974 in your bank account, you would have 974 left. Not this, not with an IUL. With an IUL, you still have 1974 in your bank account. You just borrowed from it. So the growth that you're seeing, that 6.96 up to whatever it is, it's still growing as if. So that means even if they were charging you 2, 3, 4, 5%, borrow that $1,000 and you're making 7, 8, 9, 10%, wouldn't that make sense, right? Because of course it's growing, and of course you still have the living benefits. Now you say, hey, wait, why would I do that? Well, because you have life insurance at the same time and it's growing. Well, if you died, they would just take away that $1,000 or whatever you borrowed from the death benefit. So that's the collateral. That's why it makes sense. Here's what I mean by that. Over time, when I'm talking about the cash growth, over time, let's say in 10 years, you paid $24,000. What's available to you? $27,000 in cash, right? Now, this column here, surrender value, that means if you decided to take your money and run, like you said, I don't want to do any more IULs, I'm done. You would have 1553, which is not too bad still. That's like, there's a little percentage of a surrender charge, if you will. So 1553 divided by 2,400. So you would get 64% of the money you put in year one, which is not bad. It's almost as good as an ROP, because an ROP, a return of premium, cashback program, you couldn't get your money back anyway until you were 25 years into the policy. Here, you put it in, hey, if you say you want to quit the policy, you at least get 64% of that money back. That's pretty good, right? So yeah, it's not a bad deal. But as time goes on, here's what we look at. Your cash value continues to grow and grow and grow and grow up until it just grows. And that's the whole goal, is to be able to create a tax-free retirement at age, so he's age 65. So look at this, age 65, this is where we design the policy to stop, right? So if you look at it as it is, so that if the market was terrible, this is what it would pretty much end. I don't want to say end, but your account value would be at 62. You would just have that much money available. Now your surrender value, that's left because they didn't make much money, so you're not getting much money either, right? So you see how it kind of dwindled down little by little as time went on. Now your death benefit, it was okay, but why did the death benefit start going down? Well, because if the market died, meaning 10 years in a row of no one making money, if no one's making money 10 years in a row, how is anyone going to stay in business? That's what it's saying. If they're not going to stay in business, how are they going to pay you? Like if it's all going to hell in a handbasket, we got bigger problems, right? So this is not realistic. All it's saying is the policy will die because it costs so much money to insure a 65-year-old for $123,000. You're only paying, whatever it was. I think I put $100 a month, $200 a month, and it's more than that. Plus you get living benefits, all that stuff. It's growing, so it's going to eat from your cash value. So you won't have to pay any more, but at some point, the money that your cash value has will be so low, it won't be enough to compensate for what it really costs to insure a 65-year-old at that age. So in other words, it'll die. This is that first scenario. Second scenario, same thing, but the realistic scenario, here's what you look at. This is called generational wealth. This is how you build. There's a question on here. Someone says, I believe first app is on paper. I believe, get with Anna. I believe if you have one, you got to submit first one on paper. So, hey, do it on yourself. Even then just initiating it will create F&G. F&G, again, I just ran an illustration for a guy, NLG, and pound for pound, F&G crushed them. Everyone knows F&G will crush anyone else in IULs. So this is the growth, guys. Look at this. So he's at 69 years old, he has $353,000 in death benefit. But look at his cash. I'm talking cash money, just paying $200 a month. It's almost as much as death benefit. But at what point does it go? So he keeps going down. So don't worry about this. Look at this. As he grows, his value at 73 years old, his account value. Oh, sorry. I'm sorry. That was a surrender value. I apologize. This is his actual cash value, meaning cash he can pull from, tax-free, right? Come on. So if he died, he would get 353, but the cash value you can pull from is 400 grand. And as it grows, you're going to notice it just keeps growing, and so forth and so on up until this amount of money. So you notice it starts going backwards as far as his death benefit, because why? Well, he doesn't need that much death benefit because he has cash value. You get one or the other, not both, right? Because if your death benefit is higher than your cash value, which one do you want anyway? The death benefit, right? So this is F&G, guys. It's simple. The underwriting, I found, it's a lot more forgiving. I'll say that much. You have a little bit of depression, and with some other companies, here they're a lot more forgiving when it comes to that. So I wish we had it on a different platform where people can kind of speak, but this is the huddle. So that's F&G, guys. I will suggest if you get some sniffs of IULs, it's a great thing, but don't get tripped up by it. Again, it's go there for the reason you went there. Do that. And then, hey, set up another appointment, and hey, bring myself along, bring some of the other people along, let them come and help you, get it done. And just don't get so caught up in tidal wave selling, where you're trying to get all the different policies. Oh, you have 401k? Oh, let's do that right now. Oh, you have this? Just, if they filled out a form for file expense or life insurance, just get them that. I'll say this last thing. Well, how do you find IULs? Here's an easy way to find one. If you're doing the financial inventory properly and you're asking the right questions, one question is, as you ask, hey, how much they bring in, monthly, and at their job, you ask a question like, hey, do they offer any, do you have any 401s, IRAs? Does your job offer anything for retirement, like a 401k? Yeah. I'm assuming you're participating. Do they match? Yeah. How much are you participating? They say, how much do they match? They say 5%. How much do you put in? You'll find often people say 10%, 12%, 16%, something crazy. Well, here's what you do. You say, you know what? That's kind of crazy. You do know why they only match 5%, right? They'll say, no, why? Well, that's the percentage that they guarantee to get back. So any percentage above that, you're taking your money to Vegas. This is just going like this. They're like, oh, I didn't realize that. Think about it. If you were starting a business and it was supposed to be 50-50 and your buddy put in 25, would that make any sense to you? If they knew they can get back 12%, don't you think they would do that too? Duh. So people, all the excess money above what they match, that's the money you use. So let's just for easy math, again, I don't want to complicate it, but what I'm trying to say is, if you can, on the financial inventory, circle money, find where they're already expending money, and your job is just to simply reallocate those funds to ways where it's a lot more effective and you don't add another bill, that is where you find IUL money. So if they're bringing $4,000 a month and they're participating 12%, that's $480 a month, right? Well, $4,000 a month, they only match 5%. So 480 minus $200, which is their 5%, that's $280. So you circle that. So the excess, instead of doing that, that's $280 of premium that you just found. You see what I'm saying? So you don't have to beat them over the head people are already paying this stuff. They just don't understand that a 401k is dead, y'all. They have a 401k, save them. Because I've had people, even my own parents, they have this massive amount of money in the market. And some of you have experienced it where you have this massive amount of money in your 401k, but if the market drops, what happens to all that money? It goes down. Whereas you were reinvesting that money into an IUL where you cannot lose money. That's why you need to save these people, because they don't know any better. They think that's the only option they have for investments, but you have better. So that's it, guys. Any other questions before we call it good? If a retirement plan can be rolled over to an IUL. Sorry, you're asking if someone has an IRA or a 401k, can they be rolled over to IUL? Yes, okay, good. I want to make sure I understand your question. Well, it depends. That's one option. I've done it before. You can do that because you can start with a lump sum. Now, it depends on how old you are. Some companies, they can't even take it out because they have to be with that company for X amount of years for them to be what they call vested, right? Enough for all that money that they matched for them to even give them that money. So just because the company says that they'll match does not mean that if you leave 2 years in, that you'll be able to take all the money that they supposedly would match. They have some kind of backwards way of, taking their money away. But if they're a certain age, like the guy that I was helping, he was like, he was under retirement and he needed to wait like 2 more years. It wasn't gonna be retirement age. It was like 2 more years. And at that age, like 59 or something like that, he couldn't actually take that money and put it somewhere else. And that's what we're gonna do. We put a certain amount of money now, and we're gonna use that money somewhere else. That's what we do. So what we normally do, if someone is able to, they have a 401k, one big option is an annuity. We look at annuity, and that's actually another huddle we'll do. Perhaps we'll do that next week or the week after, and we'll have Anna go over why an annuity, what it does, when you can sniff one out, what to do when you find one, because an annuity is like an elephant. It'll feed you for a season. The cool thing about it, you think about an elephant, it's all big. Well, you don't have to be the one to take it down. All you need to be is the one that's the bird dog. Find it, and the rest is history. So great question, Jose. Yeah, you can roll over 401s, IRAs into that amount. It depends whether it's best for the client, because sometimes there might be penalties, right? We don't want them to penalties, but if they do an inner transfer, there is no penalties depending on certain situations. And those are the kind of situations we will help you uncover. So great.